Good afternoon, ladies and gentlemen, and welcome to the INSTEM PLC investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time via the Q&A tab that's just situated on the right-hand corner of your screen. Please simply type in your questions at any time and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all of the questions submitted today and publish responses where it's appropriate to do so. These will be available via your Investor Meet company dashboard, and we will notify you by email when these are ready for your review. Before we begin, I would like to submit the following polls, and if you'd give that your kind attention, I'm sure the company would be most grateful. And I'd now like to hand you over to CEO Phil Reason and CFO Nigel Goldsmith. Good afternoon.
Hello, everybody. Thank you, Jake. Great to be speaking to you. It's actually great for me to be in London. People may know that I'm normally based in just outside Philadelphia in our US, or one of our US offices, and it's my first trip back to the UK post-COVID. So great to get amongst the staff yesterday in our headquarters in Stonehenge, Staffordshire, and great to be getting face-to-face with some of our investors in London. Really great to be doing this with you over the IMC platform. We've been using it for a while. It's been really successful, and it's been great to get the interaction with you as investors. So I really do encourage you to use the Q&A. We'd like to make this interactive. Delighted to be talking to you about our full year 2021 results. There is a disclaimer here. I'm not going to cover any of it. You can go back to it if you have the passion to read small print. I'm just looking at the answer to the poll, and are you currently a shareholder of INSTEM? And 58%, great. Thank you very much to those who are already investors in INSTEM. That's fantastic. Equally, really nice to have the opportunity to talk to 45% of you who aren't, and maybe come the end of this presentation, maybe you'll be considering it. Let's use that Q&A to explore that. Also, good to see that 83% of you have listened to an INSTEM presentation before. There are 17% who haven't, so we will cover some of the information from every slide, but we won't dwell on things that most of you have heard before. So here's INSTEM. What do we do? So we're a leading provider of IT software and services to the life sciences market. Probably be around 80% of our life sciences clients are the pharmaceutical industry. It's not difficult for Nigel and I and for our staff to come into work every day knowing that what we're doing is helping bring life-changing therapies to market. Never been truer than during COVID. In terms of how we are organized, we have 4 market-facing business units, and we can explore these in more detail. I'll cover them very briefly here. An area that we've been in going back for multiple decades in INSTEM's history is study management. In this area, we are helping orchestrate laboratory and early phase clinical studies. So planning the study, executing the study, collecting data, analyzing data to come up with statistical results that would differentiate a drug from a placebo. Regulatory solutions is all about taking data from studies and getting it into the hands of the regulatory authorities. So what we're helping with here is in the non-clinical stages, submitting applications to the regulatory authorities to get permission to go to humans for the first time, and then when we get into early phase clinical studies, advancing the safety of the efficacy of the drug in human population. The other part of our regulatory solutions is getting data for already approved products that people are wanting to launch around the world into the hands of the country by country regulatory authorities so that you have permission to market your regulated product and keep it on the market in those countries. I'm going to jump to the box on the right and then come back to the in silico solutions last. Clinical trial acceleration is all around helping people with 2 things. the statistical analysis of the large volumes of data that come from late-stage clinical trials. This came with an acquisition of a business called DWise. We'll talk a little bit more about that at various points in the presentation. This is an acquisition that completed on the 1st of April last year. We've been looking at various ways of having a presence in late-stage clinical trials. That's because a lot of R&D expenditure happens in late-stage clinical trials. It was an area that we had no real presence, no revenue coming from that area, that phase of R&D. But also because of the overall thesis and strategy for the business, which brings us to the in silico solutions. Our study management solutions, our regulatory solutions, our clinical trial acceleration solutions all help optimize the way research and development is undertaken today. But what we really need to do is to help the pharma industry and the wider life sciences industry fundamentally reinvent how they do R&D, because it costs too much and it takes too long. And one of the most promising ways of pursuing that objective is to bring together large volumes of data from early discovery through non-clinical and into clinical testing, potentially even then from healthcare experience as drugs are used in the healthcare setting, to bring all of that data together and to have predictive insights, to mine that data, to apply artificial intelligence and machine learning to that data. And what we have there is a growing portfolio of in silico solutions, where that is the purpose of that area of the business is to aggregate and consume and derive insight from large volumes of data. Today, a lot of that data comes from public sources, but the strategy in having a strong presence in discovery, non-clinical and clinical, is also to be able to complement that large volume of public data with the proprietary data that the pharmaceutical companies and the other life sciences companies are collecting through the use of our systems as they manage the R&D process. INSTEM has been in life sciences IT solutions since the mid-70s. We were focused in the non-clinical area, particularly the safety of new drugs and new chemicals. We've grown into adjacent areas until today. You saw that breadth from discovery right through to late-stage clinical. Over the many decades that we've been in business, we've amassed a fantastic client base, over 700 clients. Although that's big, and although we have many of the biggest clients, including all of the top 25 pharmaceutical companies as clients, this is a large market with many clients still to go after, and even many clients that we already have who only use some of our portfolio, not all of it. So we have the opportunity to sell into a very happy and satisfied client base products from our portfolio they don't already have. Over the last 10 years, we've been investing significantly to have a global platform so that we can reach out to clients and support clients in all of the areas around the globe that an appreciable quantity of R&D is undertaken. So strong in the UK, in North America, in mainland Europe, in China, in India, and Japan. One of the great features of the business is our recurring revenue. So in 2021, 52% of our revenue was recurring revenue. And what makes that particularly attractive going forward is the very high retention rate that we have for our recurring revenue. We have a key performance indicator that we should retain at least 98% of our recurring revenue by value. And we have beaten that KPI every year since we IPO'd in late 2010. And equally, on the basis that we have a philosophy of being a market leader in every area of the business we do, we have a solution. We demonstrate that through the very strong win rates that we have where business is competitive. And that continually grows our market share and market presence and deepens that leadership position. The reason that's important is we operate in a market that is not overly price sensitive. Clients want to buy the best, they're willing to pay for the best. If you don't have the best, you're likely to come a long way behind in terms of market share. This slide positions where those 4 market-facing business units sit in a typical pharmaceutical life cycle. So you see the timeline at the top in years from when you first register a patent on a promising new, let's call it a pharmaceutical or a drug, and it takes typically 12 or 13 years of R&D to bring it to market. You've then got 7 years of patent protection left to recover all your costs and the profit from that drug. And you can see that our solutions span from quite early in discovery right through the non-clinical phase of testing, through the clinical testing, and then on to market. And as I was saying before, what we do here is we help people with the efficiency of these processes as they undertake them today, and then through our in silico solutions to reinvent those processes, potentially removing study management activity. The more successful our in silico solutions are, the more it's likely to cannibalize business that we generate in study management. But that will happen progressively over time, and economically, the return from our in silico solutions will more than compensate from any loss of revenue in study management. So taking that platform, what's the ambition for growth? Well, 5 years ago, maybe 5 or 6 years ago, we set a target when we're a 25 million pound revenue business to grow to 50 to 75 million organically and acquisitively over the next 3 to 5 years. Well, you may have seen that we've just reported 46 million pounds in revenue, but that only includes a part year from 3 acquisitions that we did in 2021. And so the pro forma revenue, if we'd had those 3 acquired businesses for the whole of 2021, our pro forma revenue for 2021 was probably somewhere between 53 and 55 million. So we've already got to the lower end of that 50 to 75 million range. So we reset this aspiration last year when it was clear that we were already well advanced in the 50 to 75 million range, and said, once again, in the 3 to 5 year period, we wanted to double to triple our revenue. And we're making great progress. And we can come on to talk about how we see that progressing in the future. But overall, we see 3 threads to growth, and we'll talk more about these on a subsequent slide. But it was important to just set the scale of our ambition early on in the presentation. So at this point, I'm going to hand over to Nigel, and we can look at some of our full year 2021 financial and operational performance.
Thank you, Phil. So this is just a snapshot of the key metrics that arose in the full year 2021 with the 2020 full year comparables along the bottom. We have a calendar year, financial year, 1st of January to 31st of December. As Phil said, the 3 acquisitions that we made last year were transformational for our business, driving our revenues from 28 million in 2020 to 46 million last year, and that was only a part year. And of course, that then flowed through down to profitability and also cash generation. One item there was down on the year before was our margin at 17.9%, and that is a combination really of an impact of the acquisitions that we made last year. We set a target of 25% as a short to medium term ambition. We were on the journey for that. It will be impacted, no doubt, as we go forward by further acquisitions. Last year, the Edge acquisition that we made, a smaller UK business, has a very high margin at 30% plus. DWise, the larger, more transformational acquisition that we made, has a much lower margin in the teens, in the mid-teens, and therefore the combined margin overall was just under 18%. So we need to continue to build on that. Phil mentioned about margin improvements on his last slide, and that's something we'll be focusing on as we go forward. We have a number of areas that we can attract better margins to the business, both leveraging our infrastructure that we have globally, and one of the attractions for businesses to join the INSTEM group, where they can drive their revenues and without the commensurate increase in cost. We have the move to SaaS, which Phil will talk about a little later, which is going to drive margins, and also leveraging our people around the world in the lower cost territories, switching contractors to employees, switching higher cost employees into lower cost areas. So there are a number of areas that we can drive margins, and that's what we intend to do. The other note on here is probably the cash, worth mentioning. Large cash balance at the end of 2020 as a result of a 15 million very successful oversubscribed equity fundraise in the market, and that was to actually fund the 3 acquisitions that we made in 2021. And that funding has now been completed. We spent all that money making those acquisitions, but nevertheless we've continued to generate our own organic cash, and we were very pleased with the end of the year 15 million gross cash position to enable us to continue to grow the business as we go forward. This slide just has some operational and strategic highlights from the year. Many of these you will see when you read our announcement we put out this morning. On the left-hand side, operationally, our strategy is organic and acquisitive growth, and that's what we intend to do going forward. Move to SaaS, as I mentioned, continue strong cash generation. We had a really good year for operating cash generation. We had some big cash collections in China just at the end of 2021, which we're very pleased about. And on the strategic side of things, those acquisitions, as I've said, have transformed the whole business and how we position ourselves in the market. This slide is quite busy. It just pulls out some of the financial highlights. Much more detail is in the RNS announcement that we made today. Some of the snapshot key points on the revenue top line. As you can see, our organic revenue growth was 7%. With the constant currency, it was actually 12%. I think it's a point worth making that we don't want to just be seen to be making acquisitions to bolster our growth, because our organic growth in itself is very, very strong, and we're very pleased with that. Recurring revenue, which is a big focus for us, which is a combination of our annual support and maintenance and our SaaS revenues, grew in absolute terms. It actually fell in absolute terms in terms of the percentage of total revenue, and that was driven by a new revenue stream that came in through the DWise acquisition of consulting revenues, and we'll see that on a further slide. In terms of operating expenses, payroll remains our largest cost. As you can see, just over 70% of our total expenses. We have approximately 480 people now working for INSTEM across the globe, and obviously that contributes a significant amount of cost to our wage bill. Development costs included in those operating expenses increased to 4.9 million. 1 million of that was due to the DWise acquisition, and as we'd expect, when we buy these companies, we are investing in new products, and that's part of the rationale for the acquisitions. And the growth, particularly in that development cost at DWise, was from a new product called Aspire, which is in development at the moment, which Phil can refer to later. In terms of other comments on here, probably pension scheme is just worth mentioning. We have a triannual evaluation on our defined benefit pension scheme. It was closed. We actually completed that exercise in 2021 for the 3 years to April 2020. As you can see, the deficit actually came down to 2 million from 3.8 million. The cash outflow per annum was around about £600,000, and that's well within our forecasting capabilities. So we're comfortable with the servicing that liability on our balance sheet. I've mentioned about the cash conversion, and the cash at the end of the year was strong at 15 million. A couple of slides on revenue. It's a snapshot here of our geographic spread. We have pulled out USA separately on its own now, rather than North America, which included Canada. Historically, it's now within the rest of the world. For people that have been looking at these slides historically and trending it. But nevertheless, USA on its own stands out as the largest territory for us geographically, but with a nice spread across the rest of the world and Europe and UK. Rest of the world growth is China has been very strong for us yet again, so we're very pleased with that. But in all areas, actually, as you can see, the dark bars on the graph on the left are all showing growth in all territories. In terms of revenue by type, these bars on the left-hand side show the various components of our revenue streams. The new revenue stream that I referred to before on the 2021 revenue is right at the top there. The consulting services from DWise contributed just over £7 million in the year. Our recurring revenues, as I mentioned, annual support and SaaS, which are the bottom part of the bars, the sky blue and then the darker blue towards the top. The combination of those was a 43% increase year on year, which is very pleasing. And we pulled out SaaS revenues on the right-hand side just to show the continued growth in that revenue stream, 21% increase between 2020 and 2021. This slide shows the 4 sectors or operating segments of our business. Just to scale them, you can see that study management, which includes our legacy software product, Provantis, continues to be the most dominant of the 4. There were 3 business segments up until the end of 2020. With the acquisition of DWise, the new clinical trial acceleration business unit was created. So as you can see, contributing £12 million to revenues in the period. And my final financial slide just summarises the 3 acquisitions that we made in the year. I don't expect to go through them in any great detail. You can see when they were acquired, how much they were acquired for, and the deferred and contingent consideration that remains to be paid or has been paid already in 2022. We put out an RNS this morning to confirm that the earnouts for DWise and the Edge have both been achieved and would be paid out in full, which is a real win-win for both the INSTEM and the vendors of those businesses. So we're very pleased to be able to pay out, because clearly they have demonstrated that they can achieve what we asked them to do in that period. So well done to them. And there is no earnout associated with the PDS acquisition, so that's just a deferred consideration to be paid later this year. In terms of how we will fund that, well, we have organic cash. We've already paid out the cash that was due to DWise in the $3 million, as it says there in H1 2022. That was paid out of our organic cash reserves. However, we have just recently negotiated a new banking facility with HSBC in the UK and globally, so that will consolidate our fragmented banking arrangements in the US and other parts of the world. We already bank with HSBC in India and China, and we're very pleased that we have now up to £20 million facility to enable us to utilise that as an option for us when we undertake further M&A activity. 10 million of that is committed, and the 10 million is an accordion and will be available to us on a further approach to the bank's credit committee. So we feel very pleased that we have that as additional firepower in addition to the organic cash that we have, plus the equity fundraise options that we have and have utilised in the past. And that's all I was going to say on the financials. I'll hand back to Phil. Thank you.
Thank you very much, Nigel. Just a reminder, I do see one question in the Q&A. Be thinking about your questions and dropping them in there. That would be great. So looking forward, I said I would come back to the growth strategy slide and really picking up in these 3 boxes at the bottom. So We have products in the portfolio of different stages of maturity. Some of the solutions, if we look multiple years into the future, we're guiding that maybe you could expect a 5% organic revenue growth. Other products and services in the portfolio are growing much faster, and maybe they're 15, 20, or even higher percentage growth. But on average, across the portfolio, our guidance is expect about 10% organic revenue growth. And you can see here some of the ways that we see getting that. And we'll come on to talk a little bit more about the market dynamics that underpin organic growth and help us with further market penetration, cross-selling of solutions that we add into the portfolio, whether we add new solutions and services organically or acquisitively, the ability to be able to offer more of these AI-enabled in silico solutions, etc. And Nigel talks about margin improvement. It's a real key. This is a business that should be delivering 25% plus EBITDA margins as it grows and as we use that scalable platform and put more revenue through it. And multiple ways, I won't repeat the things Nigel said, but a big focus for us on margin improvement. And with that margin, obviously the ability, the more margin that we generate, the more we can reinvest in further future growth. And one of those ways of investing in the future is accretive M&A. Maybe outright acquisitions or mergers, maybe it's strategic partnerships, maybe they're a strategic partnership that is a stepping stone to a future acquisition, or maybe it's just a logical strategic partnership with somebody that has something complementary, wants access to our receptive client base, or maybe our geographic sales and marketing capability, support capability. So M&A, it's been a really important feature of the business for many years. When I first got involved in this business in the mid-90s, we did an acquisition in 96, another in 99, and then since we IPO'd in 2010, deliberately to enable us to accelerate our acquisition strategy, we've done further 8 acquisitions with great success. I said that I would come to a slide that enables us to understand some of the organic growth potential, or both organic and inorganic growth potential. And this is data that we've used repeatedly over the last 7 or 8 years. It's data that comes from an annual market research survey from a very respected organization, Pharma Intelligence, part of Informa, part of a public company, and has actually just done a demerger. And 2 charts on here. The chart in the top right, the total number of drugs in the global research and development pipeline, or at least the regulatory stages of the global R&D pipeline. So after discovery, once you get into the regulatory non-clinical area. And you can see that this has been growing really quite healthily for 7 or 8 years. The growth from 2021 to 2022 was 8.2%, up significantly from the 4.8% growth from 2020 to 21. Well, the more drugs that are in the global R&D pipeline, the more studies that they're running, the more need for our study management applications. Pharma companies are running these studies using our software. Contract research organizations increasingly run these studies on behalf of the pharma companies. Those organizations are running more studies, they're recruiting more staff, they need to buy more users for our software. Because they're very busy, because of this growing volume, they're also full of business. The CROs are giving study start dates 3, 4, 5 months into the future because they're so busy. As a consequence, they're able to command premium prices for their work because it's in demand. And commanding premium prices, they're very profitable, and that allows them to buy products from the INSTEM portfolio that they don't yet have, or additional services. So, this growth in the global number of drugs in the global R&D pipeline, really indicative of INSTEM's future performance. And what I've highlighted is two areas here that are particularly relevant to INSTEM's success. A lot of our solutions focused in preclinical and non-clinical are synonymous. And you can see that a lot of the growth here, 11% plus of the growth in the global R&D pipeline, were for drugs at the preclinical stage. And this really reflects the huge success that we had in our study management area, where a lot of our preclinical solutions reside, and also in our regulatory solutions area, where we're taking data from those preclinical studies and getting that data in the hands of the regulators. And our study management revenue, although a mature area, that grew 17% organically in 2021. So, hugely successful, huge growth, and these study drug increase projections, there's every expectation and belief these will continue to grow strongly into the future. The other area here, late-stage clinical trials. Nigel and I both talked about the acquisition of DWise and that introduction into the late-stage clinical trial statistical analysis market. And that, therefore, is a really important area of growth. And that, again, increased 8.2% year on year. And again, more drugs there, the more work for our clinical trial acceleration business unit. So Nigel's shared some near-term comparisons on financial performance, 2020 to 2021. This gives you a sense as how INSTEM has grown, looking back over the last 7 years. And you can see that constant revenue growth. You can see that transformational step that we've made in 2021 in our revenue growth as a consequence of strong organic growth and then those 3 acquisitions. And you can see that it's not just been revenue growth. Profit growth has also grown very strongly. Generally speaking, profit growth has exceeded our revenue growth, and that is obviously what is going to ultimately drive up those EBITDA margins. What we've also shared for the first time is not just what last year's recurring revenue recognition was, but what is the annual recurring revenue. For those people that are keen investors in software businesses, a very common metric that people have been, you included, have been asking us to provide our ARR number. So our annual recurring revenue. As of today, what do we have contracted in terms of annual recurring revenue? So I don't have the comparator number up here for our SaaS revenue in 2021, but that was £9.7 million. And you can see that already contracted on the 1st of January 2022, we have 11.5 million. So, all things being equal, as long as none of those clients cancel, and you've already heard me talk about our 98% plus retention rate, the minimum our SaaS revenue ought to be in 2022 is 11.5 million. And obviously this disregards any new business that we win after the 1st of January. So this gives us a really good insight. And if we start to look at market guidance, and hopefully people have already seen the research note that's come out early today from Progressive Research, or maybe the one from Singers. And whilst I'm going through this presentation, Nigel will look up and remind me what the SaaS revenue guidance is for 2022 and how far that 11.5 million takes us towards that number. And the 28.7 is actually the sum of our SaaS and our annual support revenue. Software as a service. We've talked a lot about this. So for the 83% of you that have been on INSTEM presentations before, this will be very familiar to you. The transition of our customers from historically being deploying our software on premise and paying us an annual support fee to actually us providing the infrastructure and delivering our software as a service. That puts us in control of the environments the clients are using. The software we provide is very sophisticated. If you're going to get the best out of it, you need to understand it really well. It layers on top of sophisticated third-party technology solutions like Oracle and SAS, the statistics software platform that is used for the analysis. You need to be very familiar with those products and how to configure and look after those solutions. It's much better to allow INSTEM to look after this environment for you rather than to install it on your premises and look after it for yourself. We have 200 clients that have our enterprise software. We have huge experience. We have 60 or 70 clients already that we are looking after software as a service. Our expertise to know how to configure and optimize these platforms is much greater than even our largest clients. So the return on an investment of paying us some more, because we charge an uplift on what people would pay us for their normal annual support if they deploy this internally. If we're going to put it on our hardware infrastructure and we're going to provide those platform technology licenses like Oracle and SAS. But if you don't have to have expensive Oracle database administration staff or systems management staff, or instead of 120 Provantis customers, our biggest product, going through the validation project when they upgrade from version 10 to version 11, if we do that once on the software platform, the SaaS platform, there's huge savings that we can share with the clients. We can make good margins, and the clients can lower their internal cost of ownership. So huge benefits for both INSTEM and our clients of moving software as a service. We're making great progress with new clients, selling them software as a service from the get-go. Over 90% of new clients in 2021 went SaaS from the outset. And although the transition of on-premise customers to SaaS moderated a little bit in 2021, as those clients focused on more pressing and challenging issues in their business, their software from INSTEM is running very well on-premise. They know it will be even better if they move software as a service, but it wasn't a problem for them, so they focused their attention in other areas. But there is a deadline. All of the clients know that by the end of Q1 2024, that's when we will stop issuing new versions to them to install on site. So they know they have to transition by then. So what's really new? So some of those things we've talked about is an update on the story as we've shared it over the last 2 or 3 results releases. Well, one of the key things, having brought together these 3 acquisitions with the INSTEM original business, what we have is that opportunity not to just have leading standalone solutions, but to start to integrate the data that comes from those solutions, and maybe even some of the workflow activities that happen between those solutions to improve the efficiency of that R&D, as I was talking about before. So having gone through the sort of the integration process of those businesses into INSTEM, the phase 1 integration for DWise and the Edge, during last year. Now they've both completed their earnouts. The more intrusive integration, which we're doing right now, the focus will turn to how do we put that integration in place? How do we take the data and leverage that data from these various solutions for compelling advantage? And the next picture I'm not going to talk into detail, but it just gives some perspective. Again, we have our solutions here across the various phases of R&D, and these boxes in orange starting to talk about where we can take data from various of our products and how we can use it in intelligent ways to inform R&D. So, for example, intelligent trial design. So it's not uncommon for a late-stage clinical trial for the belief to be we need to recruit 1,000 patients to run this trial on. We need half of them to be taking the drug. We need half of them to be taking a placebo. We need a mix of types of patients, some with other types of conditions. So maybe we've got people with hypertension because maybe there's a safety implication of our drug for people with hypertension. We need people taking other types of drugs to establish whether there's problematic drug-drug interactions between the drug we're taking already and this new drug. Well, it's not unusual if you can look at previous data to find ways to say, you know what, we know there is no problem with hypertension. That part of the recruits that we're going to bring onto that trial with hypertension we don't need. Maybe we can narrow this pool of 1,000 patients that we thought we needed down to 500 patients, which means we can recruit them onto the trial much faster. We can finish the trial much faster. The study will be less expensive, and we will complete it quick, and we'll bring this drug to market more quickly. So the ability to be able to look through that historic data to work out what the patient population needs to be, what the trial design needs to be to optimize the future activities is a really great example of how you can leverage this huge volume of data that's collected across the R&D process. I won't talk to the other examples on here, but you can certainly explore those more through Q&A if you're interested. Clearly, M&A has been an important part of the growth strategy. We operate in an industry that has exhibited very poor governance over the years. They've spread their investment in technology across many, many businesses, some big, but many very small. As a consequence, there's many, many small technology businesses out there. And that's left the life sciences industry with a problem of managing many hundreds of suppliers. And as they look to aggregate data, a challenge that their data is scattered to many systems. And so the industry, the clients want to see a consolidation of these suppliers. They're continually suggesting acquisition targets to us. And there are many targets out there, some attractive, many not attractive, some available, many not available. And so our job is to be intimately aware of hundreds of businesses that are in our target niches, to know the ones that are attractive targets, and to know the other potential acquirers out there, to the areas we can continue to differentiate ourselves and continue to bring market-leading solutions in new niches, or maybe businesses that are in the same area as us, competitors, like the acquisition we did of PDS in September last year, a business that we competed with in non-clinical study management for 25 or 30 years. They'd become the number 2 in the regulatory solutions area for creating send data sets for submission to the FDA, and the ability to be able to bring the talented staff that overlap and understand our market really well to retire a competing software product with benefits to the customers that we can now invest in one product at a greater rate than 2 products, and that will be good for the clients. We will generate more revenue, have higher margins, and to bring the number 2 SEND services provider in alongside the number 1 SEND services provider, INSTEM. So competitor acquisition can be useful, as well as acquiring complementary adjacent businesses. Funding, Nigel's talked about the fact that we raised £15 million through an equity fundraise. We used that on the 3 acquisitions last year. Those businesses, like INSTEM, are cash generative. It's filling up the balance sheet that will allow us to fund future growth, both organic and acquisitive. It's very common for us to issue equity to incoming sellers of businesses. We like to acquire businesses where the owners are staying with us and want to take some money off the table, which is great, but also want to remain shareholders in INSTEM and continue to contribute to our success and our share price growth, knowing that they will benefit as ongoing INSTEM equity holders. And we see here some important acquisition criteria. We're looking for businesses that are profitable already, typically, or will be profitable in the first full year, businesses that will be accretive to earnings in the first full year, acquisitions that meet minimum return on investment criteria. The great thing is, if we look at the acquisitions that we've done over recent years, they have all surpassed this return on capital target of 10%, and most of them are indeed moving on post synergies, revenue or cost, delivering 15+% return on capital. And we have a great acquisition track record that we can leverage. So overall, and it's great to see that we've got some questions coming through, because we are on the last slide, summary slide. And what I think I'm going to do is, rather than read these out, maybe I'll come back to these after we've had the Q&A and we can talk to the summary. And so with that, and Nigel, help me out. John asked a question very early on. Can you add anything to why the auditors did not sign off the accounts at the 11th hour? So, Nigel, hopefully you saw that question. You've been having a think about this. Do you want to answer, John?
Yes, thank you, John. And well observed. Yes, we all the audit work has been completed and was completed on these numbers that we put out this morning. As of last night, however, there were some pieces of the wording in the document. Those of you who've looked at the RNS, you'll see that it's a very weighty tone. There's a lot of words in there, and there were some changes that were made to the wording. The auditors had to sign all of those off, check them, sign them off, and they just weren't able to do that in the time that was available between last night and first thing this morning. So they did that work first thing this morning, and we were able to. They signed off the release for these results to be published. In addition to that, we have the statutory accounts, which are being worked on at the moment. We anticipate those will be signed off in the next few days. Clearly, they'll contain all the data that's already in the RNS. So there isn't an issue with the audit. It was just a timing thing. I mean, on the basis that the 3 acquisitions that we've made have made the complexity of our reporting, really detailed this year particularly. And there was a lot to get through, and unfortunately, we just didn't do it in time. So nothing to be concerned about. Just one of those things, unfortunately.
Yeah, none of those 3 businesses had been regularly audited. So they've actually gone through a formal audit, as well as a conversion of their reported financials from being UK GAAP or US GAAP to IFRS. So a lot of moving parts in the consolidation of the numbers and the auditing of the numbers. So a little bit of a one-off as we bring all of that under INSTEM. So just the volume of work. So I'm going to pick the next sequential one, and then maybe Nigel, you can help me pick the others. I'll just mark John has answered, so it goes off the list, so we don't ask that same question again. So the next question. The 11% growth in drug development is that a multi-year tailwind for your growth, or only has an impact for this year? I think the answer to that is it depends. Where the growth is in the non-clinical stage of development, quite a lot of those compounds in non-clinical, they still fail at that stage. So they will do laboratory tests, maybe laboratory tests in rats and mice. They will discover there are safety liabilities, and that will not then advance to further stages. And those preclinical studies might only last 3 to 6 months. So you get the benefit in the current year, and unless that candidate advances, there'll be no benefit to our products and services that support the later stages of R&D. However, the weight of numbers would suggest the more of those things you have at the earlier stage, the more that will make it through to the subsequent stages, which is why it's sort of a bit of a yes and no. Some of those drugs will indeed progress through, and they will support growth in later stages in later years. So large numbers in the non-clinical stage are going to be predictive of greater numbers in phase 1 clinical, then phase 2 clinical, and then phase 3 clinical in later years. So hopefully that answers that question. Again, I will mark as answered. So we've got a few questions from the same person. So let's jump to one from Michael, and then we'll come back to that first person.
There are 2 questions actually that overlap a little bit. So what is the average price increase for the contract renewals? And then there's also is the scope, Michael's question, is the scope for selling price increases?
Okay. So Nigel, do you want to pick that one up?
Sure. So our contracts are typically 12 months for annual support arrangements, and therefore there is an ability each year to increase prices. Often those contracts have a built-in inflationary factor associated with them, and that's why we always get an increase each year on the majority of our revenues. Now this year, and in fact today, we're putting a letter out to our customer base to ask for a 12% increase in sales prices. The majority of that will be impacting the second half of this year. So this is for all products and services. It's to reflect the cost increases that we've experienced through our wages, particularly the wages and salaries of our global workforce, and just reflects the situation as it stands in the market at the time today. We will wait to see what happens in terms of the response from our customers, but we anticipate that they will be accepting of it. They are also increasing their prices as a result of their wages as well. So it's just a phenomenon and a situation that we are having to deal with together really in the market at the moment. We clearly want to retain our best people, and we want to pay them decent and fair salaries, and therefore we are looking to seek some increases from our customers. So the majority of that impact will only hit in the second half of this year. So 2023, to Michael's question, 2023 will be the first full year where we'll get the impact of that. So we'll get a full first year impact on the annual fees that will be renewed from 1st of January, as well as all the new business that comes through.
And picking up on the cost side of that, Michael has said, can you expand on the impression I have from today's RNS that OPEX has increased already, but prices have not? So the OPEX increase, when market guidance was last issued in late September with our half 1 2021 results, our expectation at that point was that salary inflation would be, and what we budgeted for salary increases, which apply each 1st of January at INSTEM, would be around 5%. For the 2 prior years, it had been about 4%. It became clear in January that 5% wasn't going to be sufficient. As Nigel said, it's really important that we retain some really talented people in the organization. They're at the core of our success. What we had the opportunity actually to do was to take advantage of the exercise we were going through to look at the harmonization of salaries and benefits across INSTEM and the 3 acquired businesses in 2021, combining that with benchmarking that we do externally. And we determined that the salary increase would be around 8%, but that also, when we looked at the harmonization of benefits, typically what we've done in the past when we've got through this process is to look to make sure that no one lost when it came to benefit harmonization, and hopefully people would win a little bit and the benefits would steadily improve. And really what we did this time was to take a view that we will look across those 4 businesses and to take almost the best benefits from each company and combine those as the benefits for the organization going forward. Because for many people who are deeply committed to INSTEM, we've got many people that have worked for us for 10, 20 years. They love the market we're in. They love what we do for our clients. It's not just about their salary. The wider benefits are really important. And so providing those enhanced benefits adds about 2% to the employment cost. So what was budgeted at 5% in reality is costing us about 10% this year. And then in addition, we had already started to more widely utilize share options within the business. And so our share-based payments charge, although not a cash charge, it does hit the P&L, and that had gone up from 400,000 in 2020 to 1.1 million in 2021, and we expected that to be about the same in 22. And again, we have increased our utilization of share options, and the projections that are in the market now for 2022 and beyond, for 2022 at least, assume that share-based payments are probably going to be somewhere closer to 1.8 million. So that 10% salary inflation, 5% extra on 30 million roughly of salary expenses, plus the extra share-based payments are those extra OPEX costs, Michael, that you quite rightly identified. Fortunately, INSTEM is growing revenue really successfully and is generating profit from that revenue, some of which we've utilized to make sure that we are proactively protecting the retention of our staff. And the reality is attrition has gone up a little bit. Historically, attrition was 8 or 9%, pretty good compared to comparative businesses. Attrition has gone up over the last 3 or 4 months to 12%. Again, still pretty good against comparable businesses. And what we've done is we've taken proactive steps to ensure that, as best we can, that's not going to go up. And so far, that seems to have been successful. We've recently run our annual staff engagement survey, and those results are very, very positive. So we are coming to the end of the Q&A, to the time. We don't have a chance to answer all of these questions. So what we will do, as Jake explained, is we'll look down these. We will provide written answers wherever we can to your questions. But maybe for just the last minute, we can go back to this summary slide, and hopefully you've reached all of these conclusions yourself. But what we've seen is a material increase in our financial performance. Our revenue has gone up tremendously. Our market reach is now much greater, from discovery to late stage clinical. We've got these really positive structural drivers with strong growth in the number of drugs in R&D and a desire for a consolidation of the fragmented supplier community. We have great recurring revenue in the business that gives us visibility into future years, and that's growing as we make that transition to SaaS. We have the ability to take that 700 clients that we already have and to cross-sell solutions from our existing portfolio and from newly acquired businesses and for new solutions that we introduce in the future. And we have this opportunity to offer a whole new range of in silico solutions that help clients fundamentally reinvent the process of R&D and to bring life-changing therapies to market much more quickly, which are of value to the population around the world as we reduce the cost as well as accelerate availability, making therapies, life-changing products available to not just the developed and rich economies, but also those developing economies who often can't afford what we enjoy on a regular basis. So what we do is deeply meaningful. It's very rewarding. We know that many of our investors share that same passion with us to be in a business that has a huge contribution to make to society, as well as doing that with great revenue growth and profitability. So thank you to all of you that are already investors in INSTEM. To those that are listening to the story for the first time, or those that are still considering being investors to INSTEM, we'll very happily engage with you further to help in that decision. And we look forward to talking to you about a really successful first half performance in 2022 later in the year. Jake, thank you very much. Back to you.
Phil, that's great. Phil, Nigel, thank you very much indeed for taking the time to address all of those questions that you can from investors this afternoon. And of course, we will make all of the questions available to you immediately after the presentation has ended. And ladies and gentlemen, we'll publish those responses where it's appropriate to do so. And we'll notify you by email when these are ready for your review. Phil, Nigel, thank you very much indeed for updating investors today. Could I please ask investors not to close this session, as you'll now be automatically redirected for the opportunity to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete, and I'm sure will be greatly valued by the company. On behalf of the management team of INSTEM PLC, we would like to thank you for attending today's presentation. That now concludes today's session, so good afternoon to you all.
Thank you very much.
Bye-bye.